Hello everyone, I'm Abdul Hakim. Currently, I'm teaching at Universitas Islam Indonesia, Yogyakarta. I'm majoring in economics. I would like to thank PRAKARSA for giving me the opportunity to deliver a presentation on global tax policy on digital economy. In this second session, there will be two other speakers, namely Paul Dehan and Kitty H. I apologize if I mispronounce your names, but from Kappa Build Foundation. My presentation will proceed as follows. In the first part, I will give a little introduction about my whole presentation. The main talk will be divided into two subsections. In the first subsections, I will be talking about the principles of tax policy. In the second subsections, I will be highlighting some issues on OECD global tax policy. Let's start with the introduction. On the 3rd of July 2020, the OECD has released a new global tax reporting framework. The model rules for reporting by platform operators with respect to sellers in the sharing and gig economy, or MRGP. Under the MRGP, digital platforms are required to collect information on the income realized by those offering accommodation, transport, and personal services through platforms, and to report the information to tax authorities. With the digitalization of the economy, transactions that take place on platforms may not always be reported to tax administrations, either by third parties or by the taxpayers themselves. The platform economy also means increased access to information for tax administrations, as it brings activities previously carried out in the informal cash economy onto digital platforms. The MRDP are designed to help taxpayers in being compliant with their tax obligations while ensuring a level playing field with traditional businesses in key sectors of the sharing and gig economy. They further seek to avoid the proliferation of different and unilateral reporting regimes, allow for the use of novel technology solutions, and help create a sustainable environment supporting the growth of the digital economy. Pascal Saint-Amans, the director of the OECD Center for Tax Policy and Administration, said that the approval of the MRGP by the G20 OECD Inclusive Framework on BEPS proves that multilateral solutions to address tax challenges in the digital economy are possible, and that they are to the benefit of tax administrations, taxpayers, and businesses alike. The MRGP are part of a wider strategy of the OECD to address the tax challenges arising from the digitalization of the economy, and are designed to serve as a basis for further policy developments in increasing tax transparency to create a stable environment for the growth of the digital economy. To support the swift and coherent implementations of the MRGP, the OECD will now take forward work on the international legal and technical framework to facilitate the automatic exchange of the information collected under the MRGP. Let's now move to the first main topic, namely principles of tax policy. This section discusses the overarching principles of tax policy that have traditionally guided the development of tax systems. In a context where many governments have to cope with less revenue, increasing expenditures, and resulting fiscal constraints, raising revenue remains the most important functions of taxes, which serve as the primary means for financing public goods such as maintenance of law and order and public infrastructure. Assuming a certain level of revenue that needs to be raised, which depends on the broader economic and fiscal policies on the country concerned, there are a number of broad tax policy considerations that have traditionally guided the development of taxation systems. These include the principles of neutrality, efficiency, certainty and simplicity, effectiveness and fairness, as well as flexibility. In the context of work leading up to the report on the taxation electronic commerce, these overarching principles were the basis for the 1998 Ottawa Ministerial Conference and are since then referred to as the Ottawa Taxation Framework Conditions. At the time, these principles were deemed appropriate for an evaluation of the taxation issues related to e-commerce. Although most of the new business models did not exist yet at the time, these principles, with modification, continue to be relevant in the digital economy. In addition to these well-recognized principles, equity is an important consideration for the designs of tax policy. Let's talk about the first principle, neutrality. Taxation should seek to be neutral and equitable between forms of business activities. A neutral tax will contribute to efficiency by ensuring that optimal allocations of the means of production is achieved. A distortion and the corresponding deadweight loss will occur when changes in price trigger different changes in supply and demand than would occur in the absence of tax. In this sense, neutrality also entails that the tax system raises revenue while minimizing discrimination in favor of or against any particular economic choice. This implies that the same principles of taxation should apply to all forms of business, while addressing specific features that may otherwise undermine unequal and neutral applications of those principles. The second principle is efficiency. In the sense of efficiency, compliance costs to business and administration costs for governments should be minimized as far as possible. The third principle is certainty and simplicity. Tax rules should be clear and simple to understand so that taxpayers know where they stand. A simple tax system makes it easier for individuals and businesses to understand their obligations and entitlements. As a result, businesses are more likely to make optimal decisions and respond to intended policy choices. Complexity also favors aggressive tax planning, which may trigger deadweight losses for the economy. The fourth principle is effectiveness and fairness. Taxation should produce the right amount of tax at the right time, while avoiding both double taxation and unintentional non-taxation. In addition, the potential for evasion and avoidance should be minimized. Prior discussions in the technical advisory groups considered that if there is a class of taxpayers that are technically subject to a tax but are never required to pay the tax, due to inability to enforce it, then the tax-paying public may view the tax as unfair and ineffective. As a result, the practical enforceability of tax rules is an important consideration for public makers. In addition, because it influences the collectability and the administrability of taxes, enforceability is crucial to ensure efficiency of the tax system. The fifth principle is flexibility. Taxation systems should be flexible and dynamic enough to ensure they keep pace with technological and commercial developments. It is important that a tax system is dynamic and flexible enough to meet the current revenue needs of governments while adapting to changing needs on an ongoing basis. This means that the structural features of the system should be durable in a changing policy context, yet flexible and dynamic enough to allow governments to respond as required to keep pace with technological and commercial developments. Taking into account the future developments will often be difficult to predict. Additional principle equity. In addition to the above principles, equity is also an important consideration within a tax policy framework. Equity has two main elements, namely horizontal equity and vertical equity. Horizontal equity suggests that taxpayers in similar circumstances should bear a similar tax burden. Vertical equity is a normative concept whose definition can differ from one user to another. According to some, it suggests that taxpayers in better circumstances should bear a larger part of the tax burden as a proportion of their income. In practice, the interpretations of vertical equity depends on the extent to which countries want to diminish income variation and whether it should be applied to income earned in a specific period or to lifetime income. Equity is traditionally delivered through the design of the personal tax and transfer systems. Equity may also refer to inter-nation equity. As a theory, inter-nation equity is concerned with the allocations of national gain and loss in the international context and aims to ensure that each country receives an equitable share of tax revenues from cross-border transactions. The tax policy principle of inter-nation equity has been an important consideration in the debate on the divisions of taxing rights between source and residence countries. Let's now turn to the second topic, namely OECD Global Tax Policy. Under the OECD G20 Inclusive Framework on BEPS, over 135 countries are collaborating to put an end to tax avoidance strategies that exploit gaps and mismatches in tax rules to avoid paying tax. Domestic tax base erosion and profit shifting, or BEPS, due to multinational enterprise exploiting gaps and mismatches between different countries' tax systems, affects all countries. Developing countries' higher reliance on corporate income tax means they suffer from BEPS disproportionately. Business operates internationally, so governments must act together to tackle BEPS and restore trust in domestic and international tax systems. BEPS practices cost countries 100 to 200 billion US dollar in lost revenue annually, which is the equivalent to 4 to 10% of the global corporate income tax revenue. Working together in the OECD G20 Inclusive Framework on BEPS, over 135 countries are implementing 15 actions to tackle tax avoidance, improve the coherence of international tax rules, and ensure a more transparent tax environment. The 15 actions are: 1. Tax challenges arising from digitalization. 2. Neutralizing the effects of hybrid mismatch arrangements. 3. Controlled foreign company. 4. Limitation on interest deductions. 5. Harmful tax practices. 6. Prevention of tax treaty abuse. 7. Permanent establishment status. 8 to 10. Transfer pricing. 11. BEPS data analysis. 12. Mandatory disclosure rules. 13. Country by country reporting. 14. Mutual agreement procedure. And 15. Multilateral instrument. The rest of this presentation will talk about Action 1, namely tax challenges arising from digitalization, which is the core of this topic. Addressing the tax challenges raised by digitalization is currently the top priority for the OECD G20 Inclusive Framework and has been a key area of focus of the BEPS project since its inception. This work has delivered several important outputs covering both direct and indirect tax issues. The OECD will publish an update on the continuing negotiations to reach a multilateral consensus-based solution to the tax challenges arising from the digitalization of the economy at 11 a.m. Central European Summer Time on 12 October 2020. What is the issue regarding tax challenges arising from digitalization? Recent rapid and expansive digital transformation has had deep economic and societal impacts resulting in significant changes. This has sparked global debates in many legal and regulatory realms, and international tax is no different. The tax implications are wide-ranging, affecting both direct and indirect taxation, broader tax policy issues, and tax administration. At the center of the debate is whether international income tax rules, developed more than a century ago, remain fit for purpose in the modern global economy. The fundamental elements of the global tax system, which determine where taxes should be paid and what portion of profits should be taxed, have served their purpose well. Namely, they have ensured tax certainty and helped to eliminate double taxation, stimulating global trade. Today, however, three important phenomena facilitated by digitalization, namely scale without mass, reliance on intangible assets, and the centrality of data, pose serious challenges to elements of the foundations of the global tax system. On one hand, the emergence of new value drivers have revolutionized the entire sectors, creating new business models. This continuously challenges the effectiveness of existing profit allocation and nexus rules to distribute taxing rights on income generated from cross-border activities in a way that is acceptable to all countries. On the other hand, new technologies have facilitated tax avoidance through the shifting profits by multinational enterprises to low or no tax jurisdictions. This is the essence of the Peace, Erosion and Profit Shifting Project and remains a top priority of the work of the inclusive framework. The next question would be, why does it matter? The centrality of a predictable, efficient, and sustainable international tax system within the ecosystem of economic growth and global welfare cannot be overstated. Given the nature of these challenges and the difficulty to put borders around the digitalized economy, the approach at this critical point is clear, namely a comprehensive consensus-based solution that deals with both the allocation of taxing rights and the remaining BEPS issues. This would 1. Secure and sustain the international income tax system, and 2. Increase tax equity amongst traditional and digital businesses. Failure to deliver, however, will ultimately lead to a patchwork of unilateral actions which in a fragile global economy would harm investment and economic growth, hampering the ability of governments to collect revenues and invest in programs. The recent success of the elimination of double non-taxation through the BEPS project illustrates the strength of a coordinated multilateral approach. After asking the issues and whether the issues matter, now we are asking what are we doing to solve them. Members of the OECD G20 Inclusive Framework on BEPS have been dedicated to finding a comprehensive consensus-based solution to the two challenges arising from digitalization and committed to deliver this solution before the end of 2020. The inclusive framework has convened public consultations engaging key stakeholders including governments, businesses, civil society, academia, and the wider public, welcoming a broad array of opinions to help us finding the next step to take. To reinforce sustainability, the inclusive framework is also conducting economic analysis and impact assessments to ensure that any solution complements existing conventions, securing the integrity of the global tax system. All members of the framework have dedicated significant resources and attached substantial political imperative to finding a timely resolution of the issues at stake. Considering the importance of the challenge and understanding that global consensus is the target, we have made substantial gradual progress. The last question would be, what are the results so far? Key milestones accomplished so far in this work include October 2015, BEPS Action 1. November 2019, Secretariat Proposal for a Unified Approach under Pillar 1. January 2020, Statement by the OECD G20 Inclusive Framework on BEPS. October 2020, delivery of the reports on the blueprints of Pillar 1 and Pillar 2. October to December 2020, public consultation reports on Pillar 1 and Pillar 2 blueprints. That would be the end of my presentation. Should you have any comments or questions, you can send an email to abdul.hakim.uii@gmail.com. Thank you.